Everyone, this is Finance Meets Real Estate. We meet here every Tuesday, 6:30 p.m. Standard Time. We have amazing guests here every week. I've hosted over 100 people from the real estate industry so far. We have Michael Flaherty here today. So he's gonna talk about how he built his portfolio to, I believe, 7,500 units, or I'm sure some of those numbers change or are subject to interpretation and so forth, but generally like significant experience in the real estate industry. So Michael, he started with essentially had like background in, I believe, civil engineering, followed by an MBA. He worked like for a few different institutions, and he's been managing a portfolio of real estate, like totaling 7,500 units and above. I'm gonna let him to introduce himself, though. I'm sure you guys have read like his bio on our meetup and other places in more detail, so we'll jump into that more. And so then I'm going to pass it on to Mike, and we'll be doing an open Q&A. So if you guys have any questions, feel free to speak up at any time, or if you want to put your question on the chat, that works as well. So I'm very excited to have Mike here. So yeah, with that, let's start. Mike, I guess if you want to introduce yourself and how you started in the real estate industry.
Yeah, thanks for having me, Stefan. And I see a couple names listening in that I actually recognize. So honored to be here. I've heard really good things about you and your group. So fire away with any questions, both you and your audience, and we'll have some fun going through it. Gosh, let's see. You touched on some of it. I have a civil engineering background. I started in the really the real estate development world. Specifically doing entitlements and getting approvals from planning commission, city councils, really across the country for the likes, mostly for most national retailers, the likes of ExxonMobil, British Petroleum, Walgreens, Walmart, Home Depot. I used to work for Toll Brothers, a big national semi-custom luxury home builder out of Philadelphia. Built, probably over 2,000 homes for them in and around the mid-Atlantic. Kind of got fried doing that, went back and worked for a big global real estate development construction management firm, and managed all of British Petroleum's work in New York City and some international projects for them. They eventually bought Arco Gas on the West Coast. So I moved from New York to California. Really, I always wanted to be a developer. And in LA, got my MBA at University of Southern California, broke out with some investment bankers there, did some properties in New York and Southern California. And then 2009 hit, and it was ugly early and often, and kind of settled into the security and safety, and really the overall attractiveness of multifamily. And while I was doing all that, I had some single family homes here and some small apartments here, and had flipped some homes along the way. But had never really focused on, one asset class and becoming an expert at what became apartments. So started buying apartments in 2009. Really myself and my team, we own apartments really across the country. We have a little over 7,000 units valued at, I'd say, about $1.3 billion right now, from Seattle, Reno, Phoenix, the Midwest, Dallas, Kansas City, Virginia, and into Florida. And have been doing really value add multifamily investing for around 14 years at this point in time. That's all I do. The blinders are on. That's what I like to think we do a pretty good job of. We have private investors really located across the country. Most of my investors are in anywhere from 8 to upwards of 20 deals. And are have a good loyal following of investors that are diversifying across our deals through the years. But fire away. That's my kind of short and skinny.
Right. So I mean, that's a super impressive resume right now, I would say. And so in terms of like, so reaching to like what you mentioned, like 7,000 plus units and, starting in '09 and kind of viewing that as the perhaps safer path through the global financial crisis relative to like single family homes and so forth, and becoming a kind of an expert in this one niche, like this one commercial real estate niche. And so in that sense, like how did that process or transition go for you? Now, I know you mentioned during the, '09, it wasn't like all that pretty as far as like the single family situation, I would say more relative to multifamily, right? So how was that experience for you? And again, the decision to transition into bigger apartment complexes, and then we'll get into like more questions on that.
Well, yeah, the decision was kind of forced to some extent because I knew I didn't want to be a developer anymore. I remember at some point I had put almost every dime I had and all my sweat equity into a number of properties, and 2009 hits and you realize that money's probably gone. And I was newly married and had a baby on the way, and I realized I had to jump into something pretty fast. And I was blessed in that I had done a little bit of everything, as I mentioned before: retail development, civil engineering, single family home development, entitlements, you name it. So it was a period of time that I really look back at as the best opportunity I had, right? As Warren Buffett says, buy when there's blood in the streets. And certainly there was a lot of blood in 2009. And I kind of had the opportunity to pick what I wanted to do. And I just started studying, others and different asset classes. And, the more I researched apartments, the more I really wanted to jump in with both feet.
Mm-hmm. So in '09, like how was capital raising different than today? Like how did that work back then? Like was it, because I know you mentioned you guys have investors that have invested in, what is it, like 20 deals with you, right? So that's a lot
I
of
have
like
35 active deals,
Uh-huh.
active companies, and I have a number of investors that are in 35 of them. And
Okay.
like anything, the more you do something at life, the better you get. So it certainly has been easier to raise capital, certainly easier now than it was then, because you've created what I like to call trust and track record, right? You have investors that you've proved up what you do and why you do it, and you've performed, if not overperformed, for them across a period of time. But in the beginning, it's hard, right? And as you said, was it easier? Is it easier now or easier then? I think in the beginning, it's hard either way, right? When you first start something new and you don't have that, I'll use that term again, you don't have that trust and track record with your community and your friends and your family, and you're starting something new. You haven't gotten out there and proved to potential investors, what you do and why you do it and where you do it. It's not easy. So certainly in the beginning, I had raised some money for some of my development deals, not a lot. But the beginning's hard. People often ask, I think the first deal I did, I raised 700,000 and my partner raised 700,000. Now we raised, 10 to 20 million for a deal. But, looking back, it really just starts doing one good deal at a time, right? And, you do one good deal and create some investors, and even some of the investors you meet when you first have a deal, right? They often say no because they don't know who you are, and you don't have a track record. And then once you can prove that you close one deal and you perform, they're more interested in investing with you on the second deal, right? So, it's for me, it's been a long road of doing really good deals with really good people. And like I often say, it just starts one good deal at a time. And in the beginning, I often have to go back and look at it. Like I did one deal in 2009, right? I did one deal in 2010. I don't think I did a deal the next year in 2011. And then in 2012, I did, 2 deals per se. And then you start to pick up some momentum, you get known in the industry as a good buyer. and you have the opportunity to buy more good deals over time.
Mhm. And so in the meantime, like how do you kind of, were you full-time in real estate at that time? 09?
Yeah, yeah, I was full time,
Uh-huh.
which helped, right, for sure.
Mhm.
I remember when I lost everything, my mom was telling me go back and get a job as a bartender, and I had refreshed the resume, etc. But I had the entrepreneurial spirit, Stefan,
Mhm.
and I didn't
Mhm.
want to go back and work for anybody else. So
Right,
I
right.
kind of dug in with both heels, and knock on wood, I've been blessed. It's all worked out, but it's been a lot of hard work, a lot of sleepless nights, and
Yeah.
um,
Because I mean, that sounds tough, right? In a way, like one deal sounds like you had like 4 deals in those like 4 or 5 years, which is okay, but it's kind of like tough to keep up, with an income stream, right? It's not
yeah, no,
such a
I
high
remember
volume, so,
the
yeah,
first deal we closed was a $5 million deal in
right,
Odessa, Texas. It was 80 units.
right.
And you pat yourself on the back. That's amazing. I had never closed
Mhm,
a $5 million deal before.
mhm,
And I had some partners, right? Because I couldn't get the loan all by myself.
mhm,
As I mentioned, I couldn't raise all the money by myself. I raised about half the money.
mhm,
And I remember celebrating, and I got my share of the acquisition fee was like
mhm,
70,000,
mhm,
and my share of the income was going to be 70,000, a lot of money, right?
right,
My
mhm,
share of the income was going to be like 12,000 per year, and I lived in Los Angeles, was married with a kid on the way. I learned real fast that wasn't going to last me very long.
mhm,
So I had to go do it again, right? That's why I always say this business is a volume business, right? You got to get real good at it and do it again and again and again.
mhm,
Uh, but you're absolutely right. The first couple deals sound really exciting and sexy, but financially, it certainly was certainly got me started.
mhm.
But it takes a while to get comfortable with it. But I was blessed,
Right.
as you asked, I was blessed to have been doing it full time,
Mhm, mhm.
and
Right.
that I had the time to do it. But
Right.
the income side of it, it took a while to get comfortable. There's no doubt about it.
Yep, yep, yep. And in terms of, we have a few other questions in the chat, but in terms of like that gradual, like increase in your capital raising capacity, so to say, right? Where you're saying you started, you're able to raise 700K, but you have this whole like trust and track record, and kind of snowballs into like doing bigger and bigger deals, and that, like, was that purely I would say like a relationship and snowball effect, or was there a technological aspect where, is capital raising still the same for you now, having 1.3 billion in assets, where it's primarily a relationship and like word of mouth driven, sounds like, or has it shifted to where it's like more of like a technological, like online leads and stuff like that?
It's a great question. And our portfolio is large enough where we could certainly leverage our portfolio and our track record into doing it, using institutional money, right? Wall
Right.
Street fund money. And a lot of my competitors do. They find the deals, they manage the deals, but they have one source of capital that raises all the money or brings all the money. um we really haven't gone that route. We've stayed very tried and true to doing it the old school way of making friends and family money, and improving up on that and doing things the right way, and in exceeding expectations. And then the 10 investors in one deal becomes 15 investors for the next deal, right? It really has, the whole portfolio has been built off of referrals. Uh,
Right, right.
it's been tempting at times over the years to go the crowdfunding platform.
Mhm,
And certainly, we could have done that and had success with it, but we haven't needed to,
mhm,
because we've had so many loyal investors that want to come back for more. And
mhm,
then there's also part of me too, like it's great when you have investors that you personally know, right?
mhm,
With crowdfunding, you don't know these people from Adam, right? You don't know their
Right.
background. You don't know their experiences with investing. You don't know if they're very litigious by nature, right? You never want to work with investors like that. But we just haven't gone down that road. And then just certainly we've met with, or I've met with some family trusts that say, hey, I have 700 million and we love to invest in multifamily. But often they have terms that aren't as attractive. And then they sometimes can dictate control of the deal, and what they want to do might not be aligned with what you and my investors like to do. So again, it's been a long road, but it really started with the same people, and one person refers you to another. It's been all kind of old school relationship based and referral based.
So Cedric is asking, how many partners do you have at L5? So L5, right, that's the name of your company. So how did you choose those partners?
Yeah, good question, Cedric. I have one main partner. His name is Derek Graham. He's a great guy. He actually has a different company. We've never really merged into L5. So his investors think of him as one, and my investors think of me as L5. And we've been doing it from the beginning. I had a deal where one of my partner at the time fell short at the raise, and he was short like $500,000, and I was going to lose about 100,000 in a non-refundable deposit as a result of being short 500,000. So I called this other gentleman. He flew out to see the property. He raised the extra 500,000 in like 3 days. And, we've been doing deals together since then, but really just one partner, Cedric.
And so another question Cedric has is actually, what class of assets are you all buying now? Did you start with value add C class assets?
Yeah, I've always started with primarily B class assets. They weren't really value add when I started, because back in 2009, 2010, you could buy 8 caps with your money. Those days are certainly long gone for the moment. We'll see if hopefully it doesn't get back up to that again. But primarily it's been B and C value add. In the beginning, lighter value add, I wouldn't do anything to the interiors. I would just eliminate deferred maintenance. So me and my investors didn't have those headaches down over a 7 to 10 year hold. And we'd paint and rebrand and new signage, and put 100,000 into sprucing up the leasing center and the pool areas, and adding dog parks and improving landscaping, etc. But not a lot of true interior value add where you're raising rents. And then now it's just pure value add. We'll do the same thing as we started with, but now we're doing easily 80 to 100% of the interiors, and we're putting 15 to 20,000 in each apartment unit with quartz countertops and new fixtures and finishes and stainless steel appliances. We're doing other value add programs like doing valet trash that tenants are willing to pay for. They'll have to take their trash out to the dumpster. They can just put it outside their door as a service that'll come and pick it up. I do technology packages on all of our units as well, where we're Nest thermostats and adding an Alexa and the Bluetooth water leak sensors and keyless entry locks, and those can be other value add generators as well.
That's that's very interesting. And it's interesting you guys started actually with exterior work, right? So was that still a way to achieve like a rent increase, or
it's a good question, because you can put 2 million into that and there's no tangible way of proving up if you get any money back from that, right? But I think I remember when I was learning the business a long time ago, someone told me, hey, when you buy a new home, how often do you buy a new home and you never do anything to it? Very rare, right? Most homeowners, when you buy a home, you're going to add something to it. New flooring, maybe you're going to paint, maybe you redo the appliances. I think, from a apartment 101 standpoint, you're doing the same thing, right? You're managing people's money. You're going to be holding or owning an asset for 5 to 10 years. over that period of time, you're going to need to replace roofs. You're going to, or budget for it at least. You're going to need to paint. Sometimes, I love redoing the signage. If the signage is old and a tenant's driving by, they immediately think, oh, this is an outdated property. So I love to redo the signage, update the landscaping, and really put the property in the best position to perform operationally and raise occupancy. Because when you do that, you're going to have tenants that want to stay at your property. But you're absolutely right. It doesn't necessarily, it's hard to calculate a true ROI or return on investment on those dollars.
Mm-hmm. Right. Go ahead. Nelson.
Just a quick comment right here. Hey, Mike. Good afternoon or good morning, depending on where you're
at.
How
you doing, my friend Nelson? Good to see you, buddy.
Same here. And I'll just put a plug in. Okay. I am one of, I'm going to pat myself on the back. I want to say I'm a multiple investor of multiple deals, but, working on the pocket. But I will put a good plug in for Mike. One, he is very consistent. I'll just say right now, he doubled my IRA. I'll just put the plug in right now. Doubled my Roth IRA. And on the multifamily side, Mike is a person that I definitely reach out to because of the consistency and the ideas and then putting into action. And yeah, so it's just great to have you here. It's just great to have you on. I'm going to have to go in a little bit, but I tell everybody, take advantage of the fact that you've got Mike here. And I even say it to myself. I say, I want to be like Mike when I grow up, the old commercial.
Thank you, my friend. Good seeing you. We'll talk soon, huh?
Most definitely. All right. I'll be back. I got to take care of something right here, and I'll be back in a bit. Thank you. Bye.
Thank you, Nelson. So actually, we have a question on the chat that says, so considering you started buying in a down market, well, that's the consideration there. So how are you making these current numbers work? Are you still seeing properties or numbers that make sense in the 2020s in your market? Do you have to move to other more compressed markets to make the numbers work? Or are you buying things with tighter margins, etc.? What has the transition looked like to get the numbers you are used to getting?
No, those are all great questions, and I'll try to address all of them. I want to say yes to all of the above. Certainly it has gotten more challenging. I think you always have to be looking at other markets. Not necessarily because other markets are better, but I think as I said earlier, that you're in the volume business. The more markets the better chances you have of finding more deals. And sometimes it's in the market you don't think you're going to find a deal in. Sometimes it's not, but often you're finding deals in markets that the best. So the more markets you can add, or silos of opportunities you can add, the better. Currently it's hard to find deals right now. There's no doubt about it. I normally will close 2 to 5 deals a year. We closed 2 deals in the beginning of last year in Dallas, a $50 million and a $60 million deal with some 1031 money that we had from a really successful deal that we sold in the Midwest, and haven't closed the deal since last April. So it's been about 12 months with no deals. And we're all deal junkies and want to find deals, but I think it's a good thing. It's a very volatile time. It's been very hard to know when the Fed is going to slow down, and then when they're going to speed up. And we've seen the largest increase in Fed hikes and interest rates in history over the last 6 to 8 months. So it's been hard to buy, knowing that 2 months later rates are going to be higher and cap rates are going to be higher. So I've just been very picky, patient, and prudent through over the last 12 months, and still looking at a lot of deals and writing offers, but just haven't found anything that's penciled yet. I think cap rates need to rise a bit. Hoping interest rates begin to drop a bit, which is what's expected. And then I think the other 2 challenges are, there's not a lot of deals on the market right now. A lot of sellers have just said, hey, I'm going to ride through this period of time in hopes I can sell in a couple years when values are up and interest rates might be back down. So there's not a lot of deals out there. And then certainly some of the deals that are out there are with sellers that think their property is still valued, where it was as of August last year. And that's simply not the case, right? With what's happened with interest rates, I can't pay the same price I could for a property last August. So I think it's just going to take some time for sellers to get a little bit more realistic on pricing. And we're starting to see that. We've certainly come close on a couple of deals that, man, I would love to own. And one property in particular, I've offered on 3 times in the last 3 years. And it would be a great, feather to our portfolio. But like anything, you got to buy it at the right price and deliver the right returns to your investors. And that the price just hasn't come down to where it needs to be. So no deals right now, but I think we'll start to find some deals later this year as interest rates slow. Sometimes I think with seller expectations, they need time, right? To really understand, hey, this is their value, and it might be there for a while. So if you're really a seller, it's time to sell. So I think later this year we'll find some and maybe even start to see some distress from some sellers that might have, variable rate loans and maybe didn't buy an interest rate cap, et cetera. And that might be, underwater or negative cash flow. So I'm hoping later this year is a better opportunity to buy.
Right. That makes a lot of sense. And that's great to hear. Sounds like you guys have been very conservative actually, and very prudent, because there are few operators kind of keep doing like the same thing they've been doing in the same markets they've been operating as well. So in terms of like capital flows, have you
Hey,
seen
Stefan, there's one part of your listener's question I forgot. We have not lowered our return expectations. I get that question a lot. And, do I think maybe we could and still have and still be able to raise capital from investors? I probably do. Because people are always looking for, a smart, safe place for their dollars, and the stock market's extremely volatile and hard to follow and hard to understand at times. But we have not done that. We're still trying to solve for the same returns for our investors now as we have really the last decade.
Right. In terms of capital flows, have you seen any shift in capital flows? I know like Peter Lineman kind of very much cites those as a driver of cap rates.
Yeah.
You're kind of, concerned with like cap rates expanding in the future and so forth. So have you seen a shift in capital flows where perhaps rent growth or like differential rent growth could be driving some shift towards either Midwest or other markets? I know I've been seeing like some of the articles about rent growth in the Midwest suddenly exceeding that in other more traditionally strong markets in this market cycle, that is.
Yeah, I'll be able to answer that come the fall. It's hard right now.
Got it.
Rent growth has slowed quickly. My portfolio is really nice geographically, so
exactly. Yeah. That's why I'm asking.
All of it, right?
Right. You guys have all over.
Like Florida, we were getting 20 to 30%, rent bumps there. And this winter season has been really hard to follow. Rents have slowed. I guess my point is, I don't know yet, Stefan. I think we'll know more once we get through this leasing season, right? We're just starting to get into it. It looks a lot stronger than I thought it would, which is really what I had anticipated. I think we're going to have a really strong leasing season, much, much stronger than people thought. But we're not getting 20 to 30% increases anymore, right? I'd say on average, it's I'd say maybe 6 to 12% across our portfolio. And I think it's getting back to the norm, which, when I first started, we always just projected 3% rent growth and 3% expense growth. And, some years you had more and some years you had less, and over holding great assets over a long period of time, like Linneman often says, things tend to work out. But certainly geographically across all the markets, rents, I think, are coming down more to that norm, which is typically 2 to 5%, depending on where you are and specific growth criteria or growth variables in different markets. Did I answer that for you correctly?
It does, yeah, it does. And yeah, I agree. It's gonna take some time until we kind of figure out even where capital flows are moving and so forth, right? So
Yeah.
in terms of like, so another question on the chat. So Lonnie is asking, so would you recommend becoming a commercial real estate agent focused on investors? Why or why not?
That's a hard one. I think in real estate, as a guy like me who's done a little bit of everything and used to have my sales license, I think it's really up to you, right? I think it's about following your passion, whether you want to be an investor or you want to be a broker. I think the people that follow what they want to do and what they're the most passionate about end up being very successful. I can tell you the brokers made a lot of money over the last 5 to 8 years, probably more than a lot of investors did. They're just very different. They're very different hats to wear. Most of the successful brokers that I know in the industry, I don't know that they're investing on the side. And most of the successful investors I know are certainly not brokers. So I think they're very different skill sets and very different business models. And from my experience, the people that do the best are the ones that focus on one, either or, and become really good at it. But there are certainly some brokers that are also investors on the side, but I don't know how prevalent that is.
All right. So a question I got kind of a direct message from Darwin. So what 2-3 cities or zip codes or areas would you look for to buy a long-term multifamily less than 25 units, and why?
Yeah, I mean, I don't buy a lot under 25 units, but it really doesn't matter. Yeah, I think everyone's got to do their own research on it. I mean, I love the smile of the US where, we're economically, you've seen the best job growth. My focus has always been job growth. When I started buying in 2009, I mean, that was a horrible, painful recession, and it was a real estate recession, right? Anything that had real estate associated with it was like a 4-letter word, and we all thought it was going back to the bank, and it wasn't necessarily the case, right? But what I saw then is a lot of what I follow now. So what I saw then, where you didn't have a lot of distress in real estate, was where there were jobs. So back then, 4 of the 5 top job growth markets in the country were in Texas. So where was I looking to buy? Was Texas. Even in the best market in Texas with the best job growth, you could still find deals that struggle, right? There's always good areas and bad areas. So I think you really have to, my recommendation is pick a market that has good job growth expectations, low crime, good school districts, and study it, become an expert at it. Find where in that city do you want to be? Where are the A areas? Where are the B areas? Where are the war zone areas? Where do you see path of progress? And then make your own decisions based off that. But historically, I like the smile of the US, where we've seen job growth and net COVID population growth, which is Virginia, south all the way to Florida, over into Texas, and then up to the Pacific Northwest.
So Nelson actually had a question in the chat in terms of like, what's your prognosis going forward on the overall market? I know we kind of touched on that a few times, but I guess a more general outlook, like, are you optimistic, or you expect more deals presumably in a kind of tougher times?
I can only talk about multifamily, right?
Right.
I mean, I was at a local conference. I live in Northern California, outside of Sacramento. I was at a conference this morning listening to an economist, and I tend to agree with him. He thinks the recession will be light. And there are some asset classes that are going to struggle, right? Office has struggled. I think it'll recover. I just don't know when, and I don't know what it's going to look like when it does. So, but I'm not an expert at office and retail and industrial, but from a multifamily standpoint, I'm still very bullish on it. The best deals we've bought have been in volatile economic times, like right now. that's where we've made our most money. That's where we've bought many of our unicorn deals, because you have less competition, you have fear, you have people sitting on the sidelines. And the reality of it is, with multifamily, which is the beauty of it, it's just so risk adverse. I remember speaking at a conference in Seattle once, and there was an economist that spoke before me, and he said, multifamily is the most risk adverse, inflation adjusted cash flow stream investment. And the beauty of that statement is that's the case in good times and in bad. So, as we head into a recession, it's really hard to buy deals. The reality of it is people need a smart, safe, updated place to live, right? And that's why I believe in multifamily, and in good times and in bad. And even this economist I heard spoke this morning, he even said, which is similar to 2009, 2010, that you are starting to see people double up and get roommates as opposed to having their own apartment. Or, we know in 2009, people were living in their parents' bedrooms for years, right? To help with rent. I mean, I think in any slow downturn, you're going to see some of that, but it's not going to be as extreme as it was in 2009, 2010. And what happens when people double up? I think occupancies dip a little bit. But again, I mean, look what's happened with interest rates, right? If you're a potential first-time home buyer, you've never seen a larger increase in interest rates. Your mortgage are arguably just doubled, and you're probably not a buyer right now. You're probably a renter. So there's a lot of things, the positive things that actually benefit rentals and apartments when you go through a downturn, or like some economists think, as you're staring into the, it's not the barrel of the gun here. But things might slide here a bit, and I still believe very strongly multifamily is probably the safest place for your money from a real estate standpoint.
Right.
And I say that only because I've experienced it, right? I saw how it did when I was buying in 2009. I saw what happened in a global pandemic when I didn't think anyone was going to pay their rent on April 1 of 2020. I really didn't. I thought all of our deals were going back to the bank, and our collections that month were like 98%. And then you go through a period of inflation and everyone's freaking out, and what happened? Well, we saw rent go from 5%, 8% to 20 to 30%. And certainly we've seen payroll increases and insurance increases, but overall, multifamily is a very resilient type of real estate.
Right. And just for the record, I guess, so your first deal was in 2009, and so the one deal in 2009, one deal in 2010. So were those in what markets or states broadly were those in?
They both were in Texas. They both were in Odessa, Texas.
Got it.
Yeah. I bought an 80-unit property, and then a year later, I bought the property right across the street from it.
Right. Okay, and so another question from like Latina on the chat. So we have so we're new to multifamily and currently have investors ready to go in on a deal, but we have not been offered general partner opportunities. So how do you recommend getting in your first deal as a GP?
I might not follow that. So the question was, how do you get into your first deal as a GP?
Right. So it sounds like new to multifamily, have ready investors, so ready investor capital.
Okay.
Getting on a deal, though sounds like working on a partnership opportunities, like GP partnership opportunities with other investors. And so what is your recommendations for getting
Gotcha.
First
well,
deals?
I mean, you gotta, with this business, you gotta have deals or you gotta have money. And it's nice when you have both, but not everybody does. Most people don't. Most people either have money or they're really good at finding deals. We've been blessed, or we've been really good at both, and that is very rare in the industry. I've learned after doing this a decade plus. So, my recommendation is, if you have money, learn the other side of the business, right? I actually value the ability to find a deal more than the money, because that's a skill set that a lot of people don't have. the ability to understand what is a deal and what isn't a deal. You can make millions and millions upon that. You can build an entire career out of that. Because most people don't understand what is a really good deal. You don't really know what a good deal is until you look at a lot of deals. Like, last year we looked at 16 billion worth of deals to buy 2 deals. And the more deals you say no to and the more deals you analyze, the better you get at it. But not everybody has that skill set. So again, if you have, going back to your listener's question, if you have the dollars and you're learning to find deals, or you may not want to find deals, maybe that's not your skill set, I would try to partner with someone that does have that skill set, another individual, or partner with another company that has the track record and ability to match your dollars with really good deals and a good operator.
Mm-hmm. And now then the other question is, I guess, on the other side, so on the capital side, sounds like, so Judy's asking, so for someone without experience, who doesn't have people in real estate in their network, what do you recommend for finding partners to fund deals?
We got to put those 2 listeners together, it sounds like.
Right. Mm-hmm.
I think, and that's how I started. Right? I had to find deals, and I didn't have the money, and the honest answer, and I don't mean to have it be generic, it's finding one good deal at a time. And I really do believe if you find a really good deal, you will find the money. You still have to get out there and network, try to find investors, try to educate investors on the types of deals you're finding, the types of returns you're going to be projecting, why you're in certain markets. You do have to educate your potential investors, so when you have a deal, they already know who you are and what you do and why you do it and where you're doing it, and they're comfortable with your strategy. And so when you have that deal, they're ready to jump, and they're ready to ask questions, and hopefully they're ready to invest. But it does take some time, that's for sure.
Mm-hmm. So Darwin is asking, do you have a deal calculator or checklist that you can share when you evaluate deals?
I don't really have anything like that, believe it or not. I mean, certainly I have an underwriting template that is it's like 20 tabs and it's massive, and I don't even share that with anyone because most people would make mistakes on it.
Right.
But I started with a simple Excel spreadsheet that I got from a group called I forgot, the RE Mentor. Dave Lindahl has a great little analyzer, but I don't really have a checklist of the types of deals we like to buy. In a nutshell, mostly it's buildings built in the 70s and 80s that are well located. It doesn't have to be a Whole Foods across the street, but a good national grocer nearby, a Starbucks, good access to jobs. I like pitch roofs. I love being able to get washer dryer connections. That's huge. Certainly understanding deferred maintenance on deals is really important. You're getting individual HVACs or not? Do you have asbestos issues? Do you not? But I'm sorry, I don't have. I do have a due diligence checklist that's like 40 pages long that I've used in the past and I have shared with people, and I am happy to share that. That's probably more than you need to know, but that's the key of being really good at due diligence, right? You have to ask a lot of questions and prove to your investors you're doing the right thing by them.
Mm-hmm.
I'm happy, Stefan, I'm happy to send that to you or any of your listeners.
Sounds good. But let's say in terms of like for beginner investors in multifamily, would you recommend starting with, I guess, what you did, like kind of lighter rehab at first, sort of having like fewer variables? Is that?
I would. I mean, those are still my preferred deals. I'd rather not do heavy construction on all the units, and it depends on the types of deals you could find. But yeah, that's how I would recommend starting. Find deals that are well located but have operational issues. Maybe they're a little tired on the physical side that you can fix up. New roofs, paint, signage. sprucing up the amenities. Mom and pop managed deals are great to buy. So some folks that own properties 30, 40 years are just cashing checks and they're not taking care of the property. They don't realize their rents are undervalued or under market. Those are great deals to buy. Actually, my favorite deals to buy.
But at your current deal size, is that feasible? So let's say 5 million, that's more viable,
Yeah,
right?
I mean, typically I like to buy, deals that could be kind of between 5 million and 40 million plus or minus.
Right. So do you focus on agent relationships or you guys do direct owner as well?
Yeah, it's a little bit of everything, right? As I mentioned earlier, it's the volume business. You got to look at any deal that comes through your door. And it's hard to prioritize one. Everybody wants an off-market deal, right? But sometimes the off-market deals are the ones that are overpriced because they have a seller that is unrealistic. So you got to look at everything, right? Relationships, property management companies can be good sources of deals. Talking to banks right now, I think, is really important. And mailing campaigns. I used to do mailing campaigns. One of my better deals I got off a mailing campaign, which is miraculous, very low rate of return, but they do work.
Right.
And but most of the deals we're getting through brokers or broker relationships that we know, have met before, I've had dinner and drinks with, and probably have closed, a couple of deals with.
Right. So we touched on this already, but Willis is asking, so with the anticipation of recession, will you and your team expand your markets? Which markets do you think will have better opportunities in the next downturn?
Can you repeat that one last time?
So yeah, so with the anticipation of a recession, will you and your team expand your markets? And which markets do you think will have better opportunities in the next downturn?
I don't know the answer to that yet. I can tell you that we're always looking to expand our markets. We're always reading, trying to find that new emerging market. Coming out of COVID, a lot has changed, right? You had markets that people were leaving, and I don't think most economists really know the net result of that yet. I think you have some markets people told you don't invest there because people leaving and people are coming back. So it's kind of, you're starting anew again, and it's the process of reading and learning where there's rent growth, as I said earlier, where there's jobs. I like to invest where good management companies are. Regardless of what that market is. If I find a deal and I know a management company that manages 4,000 units in that market, I'll probably get really good feedback on that market from this management company because they know it so well. But I don't have any secret markets off the top of my head, other than we are still looking at where there's historically been job growth, which is the Southeast over through Texas into Phoenix. But
Right.
sometimes the best deals are in your backyard, and sometimes I'll get a call from someone that's got a deal in Minneapolis, Minnesota, and it's a fantastic opportunity, and we're very interested in it. So I love to invest in the story of the deal and the story of the market. And I'm very honest with myself and my team. We don't know every deal and every market and every seller and every story. So we'll go to where we find the best investments.
Right. And so Cedric is asking how you had to hold distributions in the last year with the current state of the economy.
That's a great question. We're in the middle of doing distributions right now. And the first quarter has been amazing. I think the second quarter is going to be that much more amazing, and we've just been pleasantly surprised with it. A lot of these deals we've owned a long time, and again, they're still recovering from COVID, and we finally have been able to evict people and eliminate concessions and improve collections. So there's a fear factor looking forward, but on a lot of our properties, we're seeing better numbers now than we've seen over the past 3 years, because we're recovering and kind of settling. Things are settling down. So no, we have not missed any distributions on any deals over the last we've never missed a distribution on any deal, Cedric. The only distributions we've delayed have been some of the newer deals we've bought, which are different kind of deals, heavy value add deals, where we were raising rents across all the properties, all the units. And the structure, we were not promising distributions every quarter. We were just promising like a 9% preferred return over 3 years. So those types of deals, the deals we bought over last year, we have not done distributions in. But anything beyond that we have fixed rate debt, we're seeing really good distribution numbers this quarter.
Mm-hmm. So, okay, Cedric, go ahead. I see you raised your hand. Actually, you want to add something to your question?
No. I did that
You're
by
good?
accident. No, that was a
Okay,
great
no
answer.
worries.
Thanks, Mike.
No problem,
Sounds good.
Cedric. I see your Ari Mentor shirt on. I love it.
Oh yeah.
I used
Thanks.
to do some coaching for them.
Oh, okay, great. Yeah, started with them.
It's a
Yeah.
good group. Good group.
Yep.
Great education.
Very nice. And so question from Eric. So can you share what some basically some details on your first deal? I know you mentioned your how much capital you raised and your partner raised, but so how much liquidity do you have? Do you put any capital up or have skin in the game? Did you have to put in more capital than expected? Did the deal go like you explained it to your capital partners, or did you hit some snags? So did you win or lose on it? It's like a very long
On the first deal or any
yeah,
deal?
on the first deal, yes. Purely the
Yeah.
first deal, complete
The first
picture on the
deal, I
first
kind of touched on it where my partner came in short and we had to huddle and bring in another partner to bring in some money at the last second.
Right.
That was stressful when you're about to lose $100,000. And especially when you have your investors lined up and your partner didn't, just didn't happen for them, not his fault, but some of his investors decided not to invest, and then you got to scramble.
Mhm.
Yeah, that's really the story on the first investment. I mean, we bought one deal where closing was a nightmare because the gentleman ended up in jail. And then he lied about the value of the property, of the purchase price of the property, and we had to battle with the county assessor's office. I mean, we have so many crazy deals. It was a deal in Kansas City, and we were just improving the paint, and we were going to improve the leasing center, and the city shut us down and sued us. They didn't like the color of the paint, and they stopped us from rebuilding the fitness center and the pool, and we didn't have any amenities for the first year for our tenants. That hurt. They sued us, we sued them. I mean, sometimes you run into these crazy stories, but those are a few snippets for sure.
Got it. And so Bradley is asking, do you have to file SEC documents or Securities and Exchange Commission documents? Or have you found a way to structure?
We don't, because we have a waiver on that because we don't advertise.
Got it.
So we're not out quoting returns. We're not out doing crowdfunding. We're not out, putting up billboards promising investors returns. We certainly have to file once we close certain data on our investors and where they're from and what states they're in. But we're very black and white with SEC compliance. But it's a different level of compliance from those who are out there officially advertising and promising returns to the public. We only deal with accredited investors and a small percentage of non-accredited investors that are classified as sophisticated and experienced.
Okay, understood. So Eric is asking, being an engineer, did you have any issues initially with overanalyzing?
With overall initials and problems initially with what?
With overanalyzing.
Oh, no doubt about it. Absolutely, Eric. That's a good question. Yeah, I still do, right? We're really good at dotting our I's and crossing our T's, and we're really good at due diligence. But yeah, it's that's my greatest weakness sometimes, right? Asking too many questions and moving a little too slow as a result of it. I like to think it's what makes me really good and our team really good. But also, at some point you learn, if you overanalyze too much, you don't get anything done, right? In the beginning, I had a list of the 10 items I wanted on every deal I bought, and I realized really quickly I couldn't get that 10, right? If I found a deal that had 7 or 8 of my top 10, I better go buy that deal. And that's just one of the examples, but certainly you got to get used to taking some risk, because unfortunately you don't have an answer to every question you have until you go through due diligence and put the property under contract. Great question.
What systems and procedures do you use to be able to grow to 7,500 plus units? How many employees do you currently have?
Gosh, we have around 8 of us. I have an asset manager who's a rock star. Again, my partner that's been with me, right, the whole way through this, and we each try to raise the same amount of capital in each deal. We both have assistants that eventually have become investor advisors. We've had through a decade anywhere from 1 to 3 acquisition people, and we've got a great relationship with a couple big national management companies. That's our top 10 in the nation, and have great people and great training and great construction management groups.
Got it. So I know we're a bit over time, and now you kind of have a time limit, Mike, right?
I do. I have to pick up a little one to take her to volleyball here.
Okay.
So I need to hit the road in a couple minutes here, unfortunately.
Okay, so let's take perhaps.
I'm happy to do it again if you'll have me.
That would be awesome. That would be awesome. So let's take perhaps like last question. Someone wants to raise their hand. We have some more questions on the chat, but let's just have it more interactive. Okay, go ahead, Eric.
Hi, Stefan. How are you?
Yeah, good. How are you?
So, good. So I was just wondering, for the partners or the investors that you use for your deals, other than preferred return, is there any sort of profit sharing, or is it just strictly preferred return?
Yeah, what we do is we'll do most of our deals are really heavy cash flow deals. So we've never even been asked to do a preferred return, because normally we've been over delivering to investors, but we'll do a 6% cumulative preferred return, and usually a split of 80-20. Sometimes it's 75-25. I've done deals where I've given 100% of returns to the investors until we refinance, but usually it's 80-20, which means that every dollar that comes in, 80% goes to the investors, and then same thing when we sell. Normally, every dollar that comes in, 80% goes to the investors upon achieving, a 6% preferred return. Every deal is a little different. We've done 8% preferred returns. I mentioned sometimes we'll do 9% preferred returns. As I mentioned, some deals we give 100% of the cash flow to the investors. We're always trying to structure a deal that we like to give investors the highest split they can, so we can match the typical returns we give our investors, which is usually 8 to 10% cash on cash returns, in an overall projected ROI of 17 to 20%. But all of our exits, our average return to investors is around 32 to 33% annualized.
Thank you, Michael.
That's great. So, okay, so let's, so Michael, like, what is the best way for people to reach you? So we got a lot of questions.
Yeah, I don't know if you have the ability to share, but my email is always the best. It's just Mike at L5 Investments, Ellis and Larry, the number 5. Let me see if I guess I can share my screen, huh?
Sure.
This is the deal we sold a couple years ago. And anyone that would like to see, this is our portfolio from the first deal I closed to the last deal we've closed, with a little snippet on what we did and what the strategy was and what the returns were projected versus what we delivered. So as I said, I always like to lead with trust and track record, and we roll this out on every deal for every new investor. I think it's important that they see that up front. Let me see. Probably easier for me to show you my contact information. Of course, I can show you this deal at the same time. There you go. At the bottom left is my name, my email, and my phone number. And you know, call, text me in the middle of the night. I'm very hands-on with our potential investors. And if you think you have any interest in working with us, whether it's with new deals or as an investor, you know, please don't hesitate to reach out.
Perfect.
And I'm
Thank
happy
you
to
so
send
much.
you, I'm happy to send you our track record, happy to send you, you know, a couple sample investment opportunities like this one in Dallas we closed last year.
Great. Thank you so much, Mike. That was absolutely great. And thanks to everyone for being here and asking your questions and so forth. Have a good night. Thank you.
You got it. Thanks, everybody. Appreciate it.